Hello viewers, welcome to my channel. I'm Hashim Ali Khan here. Presently I am giving the lectures on the subject Income Tax 2. In this subject, the topic I have started income from other sources. So in the previous video I have explained you in detail regarding what are the items that may appear in this head, income from other sources. I have explained in detail regarding that this is a residual head. That means if any income does not fall in the first four categories, income from salary, income from house property, profits and gains of business or profession, capital gain. If a income does not fall in these four heads, then it will be taxable under income from other sources. It's a residual head. So we cannot give an exhaustive list of the income that will appear in this head. Any income. So, but we can take few examples of incomes. The most important example is interest on securities. The securities are the bonds and debentures issued by government or by companies. The bonds and debentures are called securities. So, how to calculate the interest on security? Income Tax Act has divided all the securities into three categories: exempted from tax security, tax-free security, and less tax security. I have explained you in detail regarding the procedure of calculating the interest on these securities. The second part is other incomes. The other incomes are rent or hire charges from letting of plant, machinery, furniture, and family pension, winning from lotteries or dividend. These are some commonly found items of incomes which fall under income from other sources. So now in this video I am going to explain you the other incomes other than interest on securities. Right. So if you are first time following my lecture, I suggest you to visit the playlist of my channel. I have uploaded so many videos on different subjects, different topics. Select your video, watch the video till the end to increase your knowledge in the concerned subject. Now I am going to start the remaining part, theory part of income from other sources. So first of all, bond washing transactions. Bond washing transactions. Sometimes an SSC will transfer the security immediately before the due date and repurchase the same security after the due date. This he will do in order to reduce or avoid the tax liability. For example, Mr. A. Mr. A is having huge income on which he has to pay a heavy income tax. So in order to reduce the income tax, Mr. A transfers some of the security to Mr. B just before the due date. And on the due date, B is the owner of the property, owner of the security. That means the income will arise in the hands of B. Only for the namesake, A has transferred to B, because B is a poor person, he is having not much income or no income at all. So he is having very less tax liability. So A has transferred in the name of B, and immediately after the due date, A again will get back his security in his own name. This act of selling and repurchasing before the due date and after the due date, just to avoid the income tax, it is called bond washing transaction. If this type of bond washing transaction happens, what the Income Tax Act will do? The Income Tax Act will calculate the tax on this transferred security and put it to tax in the hands of original transferor. The original transferor is Mr. A. So Mr. A has resorted to this act of bond washing transaction. So whatever tax liability is there on this transaction, that will be put to tax on Mr. A's hands, until and unless he has proved that he has not done deliberately and during the last 3 years he has not done this type of transaction. So if he has proved it, then it will not be put to tax. Otherwise, Mr. A, original transferor, will be put to tax. This is called bond washing transaction. Most often this will be asked in theory in the examination. Now, dividend. Another important income which is taxable under this head of income is dividend. Now, dividend is the part of profit of a company which is distributed among the shareholders, or the income of a mutual fund which is distributed among the unit holders. So in a mutual fund company, the owners are the unit holders. The company, mutual fund company will distribute the income among the unit holders, that is the dividend. Similarly, a company, a joint stock company will earn the profit, distribute the profit among the shareholders, that is the dividend. Now, dividend is an income in the hands of the investor. Now, what is the tax chargeability? What are the provisions regarding dividend income? Now, I am going to explain. Dividends are broadly classified into three: dividends declared by a domestic or Indian company, and dividend declared or any other income distributed by mutual fund, and dividend declared by a foreign company. So, to find out the taxability of this dividend, dividends are classified into three categories. First, we'll discuss about dividend declared by domestic or Indian company. Any dividend, whether it is a preference dividend or equity dividend, declared by an Indian company or domestic company to its shareholders is fully exempted from tax. But according to the new provision, however, under section 115 BBDA, if aggregate dividend received by any person from domestic company or companies exceeds rupees 10 lakh, then excess amount is taxable at the rate of 10% plus surcharge plus health and education cess. So what the new provision says, if an assessee receives the dividend from Indian company, domestic company, the total aggregate dividend income exceeds 10 lakh rupees, then the dividend will be taxable, excess amount is taxable at 10%. Suppose if a person has received 12 lakh rupees as the dividend income from domestic companies, the income tax act says up to 10 lakh rupees exempted. The excess amount over 10 lakh, that is 2 lakh rupees, that 2 lakh rupees is taxable at the rate of 10% flat rate along with surcharge and health and education cess. This is regarding dividend from domestic or Indian company. Now we'll come to the next, dividend declared by UTA. Dividend declared by Unit Trust of India or mutual fund. I told you the meaning of the term dividend. Dividend means the profit of a company or the income of a mutual fund, including UTI. UTI is also one of the mutual fund. The mutual fund company will distribute the dividend among its unit holders according to the provisions, current provisions of Income Tax Act. Any dividend received from mutual fund is fully exempted from tax. Fully exempted from tax. Now, third one is dividend declared by a foreign company. If an assessee is getting the dividend from a foreign company means any company which is incorporated outside India. For example, assessee is in India, but he is having investment in America. So from American company he is receiving the dividend here. The Income Tax Act says this dividend is fully taxable in India. The net dividend is taxable. The net dividend received is taxable. We should not gross up. Only net amount received is taxable. That's it. And interest paid on loan taken to purchase this security will not be allowed as deduction. For example, if an assessee says, I have taken a loan from bank to purchase these foreign securities, then interest paid on loan taken to purchase these foreign securities is not deductible. These are the provisions regarding dividend. Now, letting of plant, machinery and furniture. Sometimes an assessee will give on rent plant, machinery or furniture. So any amount received in the form of rent or hire charges for this plant, machinery, furniture is taxable under income from other sources, provided it should not be his business. If it is the business of the assessee to provide on rent, then it will be treated as a business income. If it is not his business, but very rarely, sometimes he will give on rent, then it will be taxable under income from other sources. And any expenditure incurred on repairs, insurance, depreciation, that will be allowed as deduction from letting of plant. Now, family pension received by legal heirs of a deceased employee. Pension is the amount which is received by an employee after retirement. Till the retirement, when the person is in service, he will get the salary. When salary cease to exist, when he retires, So after retirement, some employers will pay pension. So during the lifetime of the employee, he will get the pension, and that pension is taxable under income from salary. Mr. X retired. After retirement, he is getting the salary. Mr. X is getting the salary. That pension. Mr. X is getting the pension. That pension is taxable under that income from salary. But if Mr. X dies according to the provision, suppose Mrs. X, the wife of Mr. X, is getting the pension. This is called family pension. Family pension. So according to the provisions of Income Tax Act, family pension is taxable under that income from other sources. But deduction will be allowed. Standard deduction will be allowed under section 57(2)(a). If an SSC is getting family pension, then standard deduction under section 57(2)(a) will be allowed. To the list of the following two amounts. The two amounts are 1/3 of pension received or a fixed amount of 15,000. Whichever is lower will be allowed as deduction. Example, if a person receives, if an SSC receives 90,000 rupees, 90,000 rupees as family pension during the year. So 1/3 of 90,000, 30,000. 30,000 or 15,000, whichever is least. 15,000 is least. So 15,000 will be deducted. So 90,000 minus 15,000, the remaining is taxable family pension. Next comes gifts received. Now a number of changes have been made in the provisions for taxability of gifts. Now gift received either in cash or kind up to 50,000 is exempted from tax. Up to 50,000, whether it is received in cash or kind, is exempted. If the value is more than 50,000, then the total value of gift becomes taxable, and in such case the basic exemption of 50,000 shall not be allowed. So remember here, up to 50,000 gift received is exempted. If a person received gift to over 50,000, then it will be taxable. It will be taxable without giving the basic exemption. Example, if a person has received gift of rupees 49,000, 49,000 completely exempted. Now if a person has received 1 lakh rupees gift, so in this case the first 50,000 is exempted, remaining 50,000 taxable will not be done. On complete 1 lakh rupees, tax will be applied. Then cash or property received as gift on the occasion of marriage of the SSC is fully exempted. These provisions you have to remember while doing the problem, will come across this. So any gift received at the time of marriage will be fully exempted. Now cash or property received as gift under will or inheritance is fully exempted. So any cash or any other property received as gift through will or inheritance is fully exempted. Gift received from a relative is also exempted. Gift received from relative. Elaborate provisions are given who is a relative, who is called a relative. The spouse, brother, sister, all this list is given. These are the relative persons. Any gift received from relative person is also exempted. So these are the provisions regarding the gift. Now I am coming to the next topic. Most frequently we will come across an item in income from other sources, that is winning from lotteries. These are called casual incomes. Means an income which is earned by a chance element, luck, by chance or luck. This type of incomes are called casual incomes. The best example of casual income is winning from lottery. Apart from winning from lottery, races, horse races, card games, puzzles, or any other TV programs, television programs, or different programs are there on which by luck and chance a person may receive some amount. These are called casual incomes. And casual incomes are taxable under the head income from other sources. So what are the provisions? Tax on lottery income. Because in casual income, the most often come across income is winning from lottery. So what is the provision regarding winning from lottery? Winning from lotteries are taxed at a flat rate of 30%. It is called a special income. The winning from lottery income will not be included, clubbed with other incomes. It will be kept separately. In total income it will be included, but while calculating the tax, it will be segregated because it is taxed at a flat rate of 30%. Plus surcharge and health and education cess. 30% is the flat rate of tax plus surcharge, if any. If there is any surcharge, we add up the surcharge, but health and education cess is compulsory. But tax is deducted at source at 30% without surcharge and education cess. Now the provision of the Income Tax Act is, whenever this casual income arises, the issuing authority should make a TDS, tax deducted at source, at 30%, and remaining amount will be paid to the winner. Example, Mr. X won a lottery prize of rupees 1 lakh. He won a lottery prize of 1 lakh. So complete 1 lakh rupees he will not receive. The paying authority will deduct 30% tax. So 1 lakh rupees, 30%, 30,000. So out of 1 lakh, 30,000 will be deducted, TDS, and 70,000 rupees only will be paid to the winner, without considering the education cess and surcharge. Later on, at the time of filing the return, Mr. X has to pay the surcharge or education cess. That is the rule. No deductions are made like cost of lottery ticket or participation fee paid, etc. When a person wins the lottery, he will claim that I have purchased so many lottery tickets, I have spent so much expenditure in participating, in purchasing the lottery ticket. Income Tax Act says no deduction will be allowed for purchasing the lottery tickets or participating in the program. Now, gross prize amount is included in the total income of the person. However, this income is separately charged at a flat rate of 30%. While calculating the total income, we should take the gross winning from lottery. We should not take the net amount. Just now I have given an example. If a person won the lottery amount of rupees 1 lakh, complete 1 lakh rupees he will not get. Only 70,000 rupees he will receive the lottery. But while calculating the total income, we should take the winning from lottery 1 lakh. We should not take 70,000. The gross lottery winning should be taken in the total income. Now calculating gross prize amount. Sometimes in the problem, the gross prize amount will not be given. The winning from lottery received is given. So we have to make it gross up. We have to gross it up, and gross amount should be taken under income from other sources. So calculating the gross price amount, if the winning from lottery is less than 10,000 or exactly 10,000, received amount is the gross amount, no need to grossing up. If the winning from lottery is 10,000 or less than 10,000, whatever price amount is given, the same price amount will be the gross up amount. No need of any grossing up. If the amount is up to 10,000. If the amount is more than 10,000, here provision. If the winning from lottery is more than 10,000, then received amount is the net amount. So same is to be grossed up. If the amount of winning from lottery is more than 10,000, then the received amount is the net amount, and we have to gross it up. How to gross up? The formula is gross amount is equal to net amount into 100 by 70. By using this formula, we are converting the net winning from lottery to gross amount. Net winning from lottery into 100 by 90. This is the method of grossing up. So I have explained the theoretical part of this topic called income from other sources. So I have explained completely these provisions. What I have explained you, we will apply these provisions to the problems of income from other sources in the next video. So if you want the complete command, watch the video till the end. Don't skip in between. Then only you can be able to understand the subject confidently. You can write in examination. So if you are satisfied with my lecture, give a like to the video. Share it in your group, in your friend circle, so that more students can watch this video, increase their knowledge, and give your comments about these lectures. And don't forget to subscribe my channel if you have not yet subscribed. We'll continue the problems in the next video.